Hey everybody, it's Kenny Schaaf, your local Homes for Heroes affiliate lender. Wanted to get this out to you. I know I told you all a couple days ago in the Facebook group that I would have this out the next day. Well, as we all know, business happens. So I did not get an opportunity the last couple of days to get this done. So I wanted to make sure I got this out to you today. This strategy is a great strategy to help you make your clients more comfortable bidding over asking price. Now, this strategy is based upon somebody that's doing a conventional financing with a minimum of 10% down. It can work. For illustration purposes today, I'm using a 20% down buyer. So you are showing your client home and they fell in love with this house. It's list price at $375,000. You being the great buyer's agent you are, you call the listing agent to build that rapport with them to try to build that rapport to help your buyer maybe win the deal when it comes time. The listing agent says, "Hey, we are taking offers this weekend. We're accepting offers until 5 o'clock Sunday evening. Highest and best, we're going to make a decision either Sunday night or Monday morning." So, by the way, we are multiple offers significantly over asking price. So now you're like, great, my client really loves this house, but significantly over asking price. What does that mean? Does that mean 20,000? Does it mean 30,000? Does it mean $45,000 over? We don't know. But based on the house and the amount of traffic, you're thinking, all right, Mr. Buyer, you want this house. It's listed at 375. You're probably going to have to come in at 420 to get this house. Now, oh, and by the way, you can't have an appraisal contingency on it. You're going to have to make up the difference. So now your buyer's like, whoa, wait a minute. This is at 375. You're telling me I need to offer 420 and I've got to make up that difference if it doesn't, the appraisal doesn't meet. I've got to make up that gap. So this strategy will show your client, look, you can make your offer at the 420 and I can keep your closing cost about what they would be if the home appraised just normally with your 20% down. So your client's like, how does that work? Let me show you how it works. This is the appraisal gap strategy. So when you look at this, you're going to see we've got the purchase price of 420 all the way across the top here. But the first column here is if the property were to appraise right on contract price, which we all know probably is not going to happen. But for conversation, for argument's sake, it does. So now your cash to close for your client is around $92,935. So everybody's happy. They don't have to bring in any additional money to get it. But let's say that property only appraised for $395,000, which would probably be a more realistic number. So when you look at this, they're having to make up that gap from 375 to 395, that $20,000, but their cash to close is only a little over $2,000 more. How does that happen? Well, what we're going to do and what we can show your client is we are going to buy out the mortgage insurance. We're going to take your loan to value from 80% to an 85% loan to value. We're going to use a single premium mortgage insurance, which is going to cost a couple $1,000s because you're at an 85% loan to value. And we're going to keep your cash just right about the same it would be normally. So let's go back in and let's look at $375,000 is what the appraisal comes back at. So now they have that full $45,000 gap they got to make up. And they are like, whoa, wait a minute. That is a lot of money over asking. So now we're going to go to a 90% loan to value. And with us being at a 90% loan to value, now your mortgage insurance is going to be a little bit higher. So now you're at a $97,639 difference, but that is way, way less than that $45,000 gap. So if we go in and look at the closing cost here on this one, if it were to come in at $395, The difference is the mortgage insurance premium of $2,150. That is the difference in their closing costs on this. Not too bad. It's $2,100 compared to $20,000 appraisal gap. Now, this one, again, because this is a different loan to value, it's going to be a little bit higher. So now the mortgage insurance premium is $4,700. They are keeping their payment where we told them it would be initially. They're keeping the loan value. All of that is going to be the same. The cash to close is coming in right at this number. There's a difference of $4,700. Now, the one thing I want to show, this would probably be closer to the more realistic numbers on this one coming in. If your client were to come in, current asking price is $375, bid over asking is $45,000, total bid's $420. Well, the house appraises for $395,000. We can show your client, based upon the appreciation that's coming in, that they would make up their difference in about 11 months. So let's say it took, 30 days to close. In 10 months, they already are making up that gap. So it's a really great strategy that we can show your client on how they can actually keep the money in their pocket for the most part, where they're at. They are going to cover that appraisal gap, and it's not going to be that much more money out of pocket. Let me know what you think of this strategy. We've got several other things that we can do to help you win more business with your clients. And in the meantime, if you have any questions on how this works, or if you have a client that this may work for, call me, let's talk, and we can set up a scenario so you can show your client and make them feel more comfortable bidding over asking in this market. Until next time, I look forward to talking to you all. Have a great day and talk to you soon. Bye for now.